The inventory numbers today tell a different story than the headlines. While WTI climbs above 65 and the Brent pushes towards 70, the real news is in the distillate drawdown. Down 1.7 million barrels this week and sitting 8% below the 5-year average. That's not seasonality, that's demand. I'm Mark Roach, and this is FutureWise Energy. The refined product side is where market tensions show up first. Gasoline stocks are down, but distillates, diesel, and heating oil are the constraint. Refinery inputs rose to 16.5 million barrels a day, yet inventories draws continue. This speaks to underlying consumption strength that price action alone doesn't capture. Now, EOG Resources dropped $5.6 billion on Utica shale assets, calling it their third foundation. That's strategic repositioning, not expansion. The mega merger era peaked with ExxonMobil's $60 billion Pioneer deal in 2024. Now that's about optimizing portfolios, not chasing acreage. The rig count tells a consistent story. Oil rigs at 418, up 2 this week, but down 70 year over year. Gas rigs flat at 118, up 22 from last year. Operators are drilling what they need, not what they can finance. Frac spreads climbed to 169 crews after summer lows. Now that's completion activity targeting wells that meet return thresholds at today's oil prices above $65. These crews move drilled but uncompleted wells into production within weeks, not months. It's selective work, not a rush to complete everything in inventory. Geopolitics are driving prices more than fundamentals. Houthi attacks on Red Sea shipping keep freight elevated. Russia-Ukraine ceasefire talks introduce volatility around European gas flows and LNG arbitrage. China's stimulus measures prop up refined product demand forecasts. But here's what matters. The structural discipline remains intact. M&A values dropped from $192 billion in 2023 to $105 billion in 2024. Break-even requirements and shareholder return priorities limit mega deals. This is rationalization, not growth. India launched a major offshore exploration program. Chevron studies new Guyana wells. AI-driven subsurface mapping redefines drilling risk across E&P companies. Technology continues advancing, but within their capital constraints. The inventory picture reveals demand strength that contradicts recession narratives. Distillate draws at this magnitude suggest industrial activity and heating demand exceeding expectations. Commercial crude inventories at 415 million barrels, down about 500,000 barrels this week and 4% below the 5-year average. The market rewards precision over scale. Companies that understand their cost curves, optimize completions, and manage inventory exposure navigate volatility better than those chasing volume targets. The days of drilling for growth are over. Now it's about drilling for margins. Geopolitical premiums will persist. Supply discipline from OPEC Plus keeps price range, bound above $60. Inventory tightness supports current levels, but fundamental growth requires demand destruction or supply disruption. The sector has learned to operate within constraints. Capital discipline, technological efficiency, and strategic portfolio management define today's winners. It's not about betting on price recovery, it's about earning returns at current levels today. I'm Mark Roach, and this is FutureWise Energy.